Well, today I'm going to basically do an explanation of the calendar spread, which is a bit of an extension onto the video that I posted previously about the basics of spread trading. The calendar spread is basically one of the most easiest in its composition, but probably one of the most widely used spreads out there. So let's just remind ourselves, a calendar spread is a spread trade involving simultaneous purchase of futures or options expiring at a particular date and the sale of the same instrument expiring on another date. So let's look at some examples of calendar spreads. Well, we can spread many contracts using calendar spreads, including energies, agricultural products, interest rate products, and the primary reason why we actually have these different maturities in these sort of products are actually for stabilization of prices for farmers or airlines, for example. Whereas, for example, if an airline wants to hedge their fuel costs and lock in a certain rate so they can more accurately forecast their future earnings or their future costs, they would buy oil futures, oil calendar futures, and so they can lock in that rate. So regardless of what oil is doing, that oil future will hedge the real cost of oil for them. Same with farmers, if they want to hedge against the fluctuations in price in certain crops like corn or coffee or cocoa, they would do the same, and they could buy calendars, buy future in buy a future with a certain expiry and then hedge against that. So in this example here, you can see we have three charts here, and I'm going to be looking at the euro-dollar, which is probably the most actively traded future, and this euro-dollar is a representation of the US short-term interest rate future. Contracts are normally separated by 3 months, so we trade from, as of now, the September 12, we have Dec 12, March 13, June 13, and so we separate by 3-month periods primarily, and we trade all the way as far as June 22, which is June 2022. So there's a good 10 years worth of calendars that we can actually trade. And when we're spreading these, we can actually trade anything from 3-month calendar to a 10-year calendar. There's no limit to the separation of where you're buying and selling, and as you would expect, the volatility increases as the time between the contracts increase, because the likelihood of certain actions happening within a greater time period is more, so therefore the volatility increases in this time. So here we have 3 charts to just show the type of volatility that we have with these calendars. So we have a 3-month calendar, a 15-month and a 30-month spread here. So this first spread over here is a 3-month calendar. Now you can see this is on a 60-minute chart, and if we look at this, it's been in a range of 1 tick, between 2 and 3 basically, and as you can see, it's very stable, especially in the current interest rate environment where nothing's really happening with rates. You can see that it hasn't moved much and it's very, very stable. Now if we do a bit more of time gap between them, so to a 15-month calendar, this one just happens to be the Sep 13 Dec 14 calendar, and as you can see there's a lot more movement and volatility, and the range of this spread is between 16 and 23.5. So in this particular time period we have a 7.5 tick spread. Now this further one down here is the 30-month calendar, and as you can see the spread on this one is 8.5 ticks. So as you can see the range has increased even more, and it's much more prone to interest rate sensitive news. So comments out of the Fed or any of the other central banks can affect the volatility of these spreads a lot more. So now I'm going to just look at it in real time, and if we just look here, we have the euro-dollar contracts here. Now I've got the March 13, June 13, Sep 13, Dec 13 and March 14 calendars, euro-dollar contracts here. Now what we have here, this is basically, it's called a spread matrix, where it's got the combination, all the different permutations between these 5 contracts and the prices between them. So if we want to look at all the 3-month contracts, we can look at March 13, June 13, and then we can bring up we can click it here and it will bring up the spread ladder. So today is just traded between 1, 1.5. The June 13, set 13, same, traded between 2s and 3s. Now if I want to look at a 6-month spread, I might look at March 13, set 13, and this is now traded between 3 and 4. But the further out we go in the curve, the more chance that is have more movement. So if we look at set 13, March 14, you can see that the range in this is a lot more. So it's traded between 5.5 and 7.5 today. And if we look at the biggest time difference, sort of 1-year calendar on this particular out of the contracts we have now, so it's the March 13 spread against March 14 spread. We look at this, and this is traded in a 2.5 tick range today. So this is how we can sort of see what are the prices between all of these different contracts. And now if we want to trade them, like we basically, normally these contracts all are mean reverting, so you wouldn't really look for breakouts on these. You would more look for some type of mean reversion, especially if you're doing 3, 6 and 9-month calendars. But the bigger the spread between the 2 contracts are, then the likelihood of it breaking out and such things is much more. So here, this is a chart of the set 13, deck 13 calendar. So this is a 3-month spread on a 4-hour chart, and we can see here how it's a lovely spread to trade. It's been ranging between 1.5 and 4 for the past month and a half. So, you know, this is the perfect sort of chart we want for a spread trade and to be a spread trader. So we'll buy around 1.5 2s, sell 3.5 4s, keep on doing that all day long, nick half a tick, but do it with a bit of size, and you know, it's a very safe and it's a very high probability trade. Now we can look at this is the 1-year spread. This is the March 13, March 14 spread, and as you can see here, it's got a much bigger range, but we actually traded from a low of 2.5 all the way up to 14. So you know, we've got 11.5 tick range over here as opposed to 3.5 what we had in the 3-month spread. But even so, as you would expect, the actual range of the calendar has been pretty good. It's just been a bigger range. But when we do start getting interest rate movements, then you can see quite streaky action with these type of calendars, especially on a 12-month, 15 months, 30-month calendars and beyond. So this is a 1-year calendar, and as you can see, this is the chart, and as you can see, this is much more easy to predict in terms of trying to make a decision whether to buy or sell than if you're buying the S&P or, you know, the Bund or something like that. And because of this, it just makes it a much more safer trade and a much more higher probability trade. So so yeah, this is what we have for calendars. The next video I'll put out will be a bit more into the butterfly spread. Thanks for watching.